Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsor, Wealthsimple, one of the leading online investment platforms globally. Now, Wealthsimple manages over £3 billion for more than 200,000 customers. Wealthsimple prides itself on providing access to smart, simple investing without the high fees and account minimums usually associated with traditional investment management. In fact, you can open a stocks and shares ISA, a SIP or a junior ISA with as little as £1, which is far lower than any of its peers, and every client has access to unlimited human advice from a qualified investment advisor. Now, Wealthsimple also provides ethical investing options and produces an online magazine in an attempt to demystify the world of money. Money to the Masses podcast listeners can get their first £10,000 with Wealthsimple managed free for a year if they sign up at wealthsimple.com/money to the masses. You can also check our full review of Wealthsimple online at moneytothemasses.com.
Hello and welcome to episode 267 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, how you doing?
I'm good, Andy. I'm very good. Lots of audio, video content as ever. Every week I seem to be saying that at the moment, but I've just finished one piece and I'm on to the next piece, Facebook Live this week, which we hadn't done for, I think, 2 weeks since our last Facebook Live event, and it was really good and I really enjoyed it. We had so many questions. We must have got about 20-30 questions before the event and a whole load during it, so do join in on those Facebook Live events. They're good fun. You can ask me anything that you want to. And yeah, we just finished one of those today, which takes a bit of energy and brain power. And now we're on to recording the podcast, aren't we?
We are indeed. And before we go any further, if you aren't a part of the Money to the Masses community group, then pause the podcast right now. I'm going to give you the address. Go in, join it and come back. So it is facebook.com/groups/Money to the Masses. Click join group, we'll accept you into our group and you can start asking questions, answering questions and watching Damien live pretty much every Friday now. So go and do it. Right. Sorry, Damien, where were we?
Well, I was talking about the video stuff I've been doing. Actually, one interesting thing for people to look out for is the Evening Standard. They got in touch and asked me to be their money expert on their social media. So basically, I got asked a load of money questions and I obviously created video and responded, and that's going out on their socials any day now, apparently. So I did that earlier in the week. So we're not just doing all this video stuff for us and listeners and readers and viewers of Money to the Masses, but we're now doing this for readers, listeners, viewers of other publications, which is always interesting. So yeah, have a look out for that.
Yeah, excellent stuff. So what have we got on this week's pod?
I'm going to do a first piece is going to be around investing. And last week there was, I talked about absolute return funds, and actually again, that got picked up, and I think there's something in one of the weekend newspapers that will be about the absolute return funds based on my comments, so you can keep an eye on that. I think that was the Express for that one. It was quite interesting because the whole crux of that piece was how much you can learn about funds and investing during periods of stress. I know people run scared from periods like this or want to bury their head in the sand, but you can learn a lot, and I'm sort of taking that on a little bit further, and I'm touching upon something that we've spoken about recently, which is ethical investing, and in particular I want to talk about how those sort of funds are performing during this period of uncertainty. But it's also linking into another piece we did last week, which is it was to do with educating children and educating yourself about things to do with money, and in particular the stock market. We're going to take some contents. There were so many good questions from our Facebook group that I don't want the podcast listeners to miss out on some of the best bits. So we are going to splice a section of that with some of the best questions as one of the sections on this week's podcast, because I know that all of you will have watched the Facebook Live piece. I mean, it was an hour long, the event in the end. So we're going to take some of the best bits of that and put that in as a section this week. And Andy, you are going to do a piece on scams, am I right?
Yeah, the latest influx of phishing related scams. That's PHISH, phishing scams, and just a few tips on that.
Okay, so I'm going to kick off with the investment piece that I mentioned about particularly the stock market and what's been happening with particular types of funds. Now, it was interesting. I mean, I read a lot around what's going on in the investment world, and I also like to keep an eye on what other people are talking about and the things that are topical and relevant for people. And one of the ones last week, the pieces we did was about educating children about money. And because that was very topical, but evergreen, if you get what I mean. We like to do evergreen pieces on this podcast, but it was topical and timely for this period we're in terms of uncertainty and being locked down. And I also saw a piece this week that appeared in the FT about how to teach your children about the stock market. And I mean, it's a very worthwhile thing to teach your children about, I suppose, but it did make me laugh because I almost tweeted flippantly about the piece, because actually when you read it, it just seemed to be full of people who worked in the finance industry, mostly fund managers and advisors, backslapping themselves about how little Johnny, their son, is, he's really got into the stock market. He's only 8 and he already has started to work things out and is asking me questions. Daddy, is now a good time to invest? And it was just, I didn't say anything because I actually know the journalist who wrote it.
I was going to say, you said you almost tweeted flippantly. I've never known you to not tweet flippantly, so there must have been something that stopped.
Well, yeah, it's because the rest of the piece was actually quite good. It had some bits and pieces you could try and teach your children with the stock market and about the stock market, I should say. So it was difficult because it just seemed to be about people saying, this is how I teach my little Johnny. It was just full of people who work in the stock market saying how their children are so clever and they're all investing in their fake ISAs or whatever it was. So anyway,
yeah,
I did laugh with Justin, who, as you people know, he's my brother and one of the other directors in Money to the Masses, so he's behind the scenes. You don't see him as much. And we were laughing about the ways you teach your children about the stock market, and I just joked, well, why don't you just get your children, strap them into a roller coaster and tell them they've got to put their hands in the air and they're not allowed to scream and smile for the camera on the way round, and if they make it all the way round, they will get an ice cream at the end. I just thought that was kind of a similar thing. Just don't get off. You can't get off. You get off at the top, you'll probably end up dying. It'll be worse. So trust in the process, trust in the ability for the safety belts, and you'll come out the other end and get off when it's designated to get off at the end of your time frame, your slot, and your reward will be there. So we were laughing about that, and it probably isn't the worst analogy in the world about teaching children about stock markets, but it led me on to just looking at the press and what goes on in the stock markets. And I had conversations with my own children, and we were talking about they like to understand what I do for a living, and so they actually filmed me. This is part of the Evening Standard filming what my eldest daughter, who inspired me to start Money to Masses when she was born, she helped me film. And of course, trying to explain to them what I do for a living is quite tricky, but then they see bits of it. But I have spoken to them about stock markets and how they work. They're just intrigued about how these things work. And one of the things that this current period is very good for in terms of teaching people the dynamics of stock markets and share price movements and things like that is because we have such extreme moves in such a short period of time. You can see very quickly what is driving performance. So a bit like I spoke about last week on the target absolute return funds, you can start to see what makes things move. So I just want to give an example. In this environment, you could almost have a coronavirus portfolio. Now, people might think that the market is falling through the floor. Yes, we've had a really good rally, and we're butting up against the area where we're going to find out whether this rally is sustainable or it's going to roll over to head towards the previous lows we've seen. And in amongst that, you might not have known that Amazon has hit a new all-time high. I'm talking about its share price. So we're back above where we were before this crash even happened. And what it is a good example of, which is good to try and explain to children, but to anybody to understand the dynamics, is if you look at your life right now, and you think about how it's changed and what you're doing. If I look at myself, I just sit there thinking, I want to try and do some DIY around the house. I want to sort the garden out, or I need to get this. The answer at the moment is seemingly just go on Amazon and order it. And I think everybody is buying stuff from Amazon. And in fact, Amazon are having to recruit loads of people to try and meet demand. And so as a result, Amazon has benefited hugely from this current environment. So there are always winners and losers. It may be like an environment like this, there are fewer winners than there are losers. But that shows you that if a entity, a company is profiting from a period of uncertainty, or there's increased demand for their services, they're getting a bigger share of the market, then that makes them more profitable, it makes them more attractive to investors, therefore they want to buy their shares, and therefore their share price goes up. So from a perspective of a child, you could just sit there, if you're trying to explain any of this, or anybody else doesn't have to be a child, is look at your life right now and try and imagine and work out which share prices have gone up and which have gone down the most. Play a game. And one of the ones you will work out is everybody's cancelled their holidays. We can't travel. And it's no surprise that some of the worst affected stocks have been in the travel industry. It could be flights, airlines, it could be hotels. There are consumer staples, so companies that make products that people use all the time. They're not things that are discretionary spend, things that are luxuries. People who make things that people want all the time. Now, I'm not just talking about loo rolls, if people are thinking about that, but things that are products we use in terms of everyday cleaning products, things that we will use in terms of hygiene and stuff like that. Those things have done well because we're all at home and we need to consume more of that within our own house. There is, I forget the name of the company, but who make jigsaw puzzles and games. Their share prices have gone up. There are companies who produce tinned food that make soup. Their share prices have received a boost, which, if you think about it, they're reflecting this mass movement of people who are now staying at home, bulk buying lots of tinned fruit and tinned soup and all these things because they think we might be in lockdown for an extended period of time. What is everybody else doing in the evenings now? They are playing either board games or they're watching Netflix. Go and look at the share price of Netflix at the moment. Again, it's another beneficiary. Microsoft, gaming companies, so companies that produce computer games are seeing upticks in their stock prices. They aren't universal, there are always going to be nuances in these areas, but what it does, we have had such an extreme movement of change in people's behaviour, but a uniform one. Because if you imagine if people start consuming more Netflix or computer games over an extended period of time, there's a lot of other factors that come into play that influence that share price. And so you can't correlate the price of something going up or down to particular supply and demand dynamics relating to people's behaviour. It could be other things that may be relevant to the sector itself or government policy or something like that, or rule changes. So there's lots of things that come into play. It could be increased competition within their sectors. But because at the moment we've all been forced to live in a certain way, you can see how, at an accelerated pace, there are things that we're all doing that we all want. Go and look at the share price, see what happens. And that can show you how stock markets move, how they work, why their prices go up, why you might want to invest in their company because it's one that's producing something that's in high demand. It actually is in the future environment. It looks set to profit. You'll see healthcare stocks, particular ones that are trying to produce treatments for the coronavirus, have had sudden upticks, but then they might tumble when treatment is shown not to work. So that's a quick piece on the usefulness of periods like this to try and see what happens. Who might you invest in? Tesco. Do you mean supermarkets? Another great beneficiary. Supermarkets have still been paying their dividend. Bank shares haven't. And of course, bank shares have been impacted by the fact they've not been allowed to. So again, all these things, once you start to unpick a story, you relate it back to your own life, it makes sense, it makes it interesting, and then you start to try and untangle it. And if you can get people excited about things in a story and they can relate it to their own life, then you will find that they will start to try and unpick things and try and put the jigsaw pieces together, without the pun, having talked about jigsaws, but put them together to make the full picture.
It's a really good point. I mean, like you say, it's fairly simplistic in that you've only got to look on what's happening outside your front door in terms of, services and this, that and the other, so you can actually almost pinpoint where those share prices are going to be. And I can't think of another moment in history, really, certainly in our lifetime, when you could easily do that. Apart from the normal trends, holiday seasons, Christmas, things like that, you could probably best guess. But, I mean, what a time to be able to do that. It makes perfect sense.
But also what's interesting is that this is all based on the assumption that certain trends are going to continue. And it could quickly unravel if we have a period where we start to be able to loosen some of the shutdown or the constraints that we have on our life at the moment. Then the lockdowns, if they already are being loosened in other areas of Europe, then suddenly this idea that, yeah, we all got to buy Amazon may suddenly unravel quite quickly. So when it does, then you can see when the opposite happens and these things start to tumble and the other shares that were unloved have started to improve, you can then understand why. And I think it's quite interesting. But leading on from that, I did a piece for 80/20 investor members, which was a research piece called Funds for a Pandemic. And what I did is this is an almost unprecedented period in history. And what I did was really look at the consistency of funds before this period, during the severe part of the sell-off where we hit a low at the sort of mid-March, and then also the rebound we've had. So you wanted something that had done well across most those periods. It's shown a level of consistency. Because if we rebound back towards highs, you don't just want a fund that made or lost less money in the downturn because it's not doing anything better than cash. So you want something that actually had some upside. And when I did that, most of those things were largely gilt funds, global bond funds that also benefited from the fall in the dollar. There were one or two other funds in there from other areas. But I looked at what would you do if you wanted equity exposure or bond exposure. She wanted to be invested in assets. And there were only 4 absolute return funds, which you're probably not surprised about given last week's podcast. But one thing that came out of this was you started to notice a number of ethical funds that appeared in the list. And if you go back to episode 248 of this podcast, I spoke a lot about ethical funds and explained what they were and how they work and stuff like that, and how you can invest ethically, how you can do some research, because it's a growing trend. And the prevalence of ethical funds in this list, and there wasn't lots of them, but there were a significant enough number given the percentage or how much they make up of the overall universe of funds that you can invest in, was notable. And particularly if you look at just the downturn period, ethical funds had done better than their peers. And in fact, Fidelity did some research recently that showed that half of ethical funds beat their global stock index during this sell-off. And so they looked at the MSCI World Index and they saw that it fell 14.5% in March. Now the equivalent global ethical equity funds actually outperformed that index. And what is interesting, if you go back and listen to the previous podcast that I did, so 248, and in that podcast I link back and refer back to an even earlier one where we touched upon ethical investing. And what's nice, it takes on those learnings and the things I mentioned in those podcasts, and you can apply it to now and then understand why ethical funds have performed so well in this sell-off. And one of the biggest reasons is they have a high tech exposure. So all those stocks that I mentioned earlier, there was a definite skew towards tech stuff. So tech stocks. I mentioned things like Microsoft, Amazon, the work from home movement we have now where everybody's at home working online. The demand for technology solutions, Zoom and all these things has pushed up their stock prices. And so they are invested in a lot of tech because they are ethical funds, and there is just a general bias towards that sector because it's deemed as being ethically good, or at least not ethically bad, and so therefore that's buoyed their performance. The other thing is there's a lot of innovative companies within these funds, so some of them are smaller companies which can benefit from these environments if they come up with something that is particularly innovative that solves a problem relating to the coronavirus. I mean, generally speaking, they tend to be biased towards smaller cap companies. And of course, in an environment where smaller companies have been hammered because people feared what would happen to the economy in each country, the technology bias has kind of overrun that. So it's actually offset that small cap bias in some of them. But more importantly, they don't tend to invest in oil. So they don't tend to invest in fossil fuels. Some do. That's the problem with ethical investing. You would think that they all don't, but some of them actually do. So you have to check each fund by fund. But I'm just talking as a group. Then those that haven't invested in oil, or in particularly the energy sector, have done well this year, because if you look at the price of oil, it's down 70% year to date. And if you are invested in stocks that are exposed to oil, then you will have seen those stocks fall in value. And of course, the FTSE 100 has a big exposure to oil, so that's why the FTSE has done so badly. So the point is, you can look under the bonnet. So you ask the question is, why have so many ethical funds done so well? If you look under the bonnet, you'll start to learn why, and it's because they have a high correlation to things that are tech orientated and aren't in oil. So again, looking how things perform in severe market movements, whether it's individual shares or individual funds, can give you a great insight as an investor as to how they will perform in similar markets or in markets that are different. For example, there will come a time where tech stocks are overvalued and they'll get punished, and you'll see the reflection in the performance, or at that point probably underperformance, in ethical funds.
Okay, good stuff. So just before we go on to that main part of the second part of the podcast with all the investing stuff, is just to make people aware of the latest round of phishing type email scams, and also other scams that are popping up on Facebook and bits and pieces like that. I can't believe this is happening at a time when the whole nation is trying to come together and find a way to get through this. There are the scummy scammers out there that are just trying to take advantage. So the latest things to be aware of is quizzes. This seems to be what is doing the rounds at the moment. Now, it's taking advantage of those people who have been potentially furloughed. There are people sitting at home potentially bored and looking for something to fill their time. And so the scammers have found a way to get around this, and they are sending out phishing emails and also doing things on Facebook and other social media platforms in order to harvest your data. Now, you've probably seen tons of these quizzes before. Damien, you've probably seen them. Do you do these quizzes on Facebook? And have you ever seen, do you know what I'm talking about? Where they ask,
I know what you mean, Andy, and I don't.
What's your favourite colour? Give me 5 names you're also known as. Tell us where you've lived. Now, these might seem innocent, but they're not.
Yeah, and I find them just annoying when I see people who do them, just because, to be honest, I'm not particularly interested in their answers, and then and they might share them as well and get you to send them around or forward them on, even if they're not just a quiz in itself that harvests that stuff. They put it in their Facebook post. But no, I don't do them, Andy. I don't. I've learned I also understand the errors of doing it. So carry on.
Yeah, exactly right. So, essentially what you're doing there is you're giving the world and his wife the access to what is potentially your personal information. But not only that, most people use these kind of significant things like places you were born or your favourite pet or your favourite animal as part of your password.
The first street you lived in, that's a favourite. I think they all seem to have the same questions as part of the security setup in nearly every financial institution. But yeah, so they're harvesting this information.
Exactly. So as soon as you start filling in these quizzes that seem fairly innocuous, fairly innocent at the start, you are giving this information out, potentially very harmful information, very personal information to potentially scammers out there. So the way to make sure that you don't get caught in these kind of traps is basically don't do it. If it seems like it's asking too many personal questions, then just don't do it. If you do think something is suspicious, one, that's great that you've been able to pinpoint that, but you can actually do something about it to help other people. So forward any suspicious emails that you get onto Action Fraud, and you can do that by emailing phishing, that's phishing, at hmrc.gov.uk. And actually HMRC have a whole page there of potential scams that you can look at, and you can see if something you're looking at is a potential scam as well.
I like that. And one of the things on there, Andy, is do you ever do these show yourself or share a picture of yourself when you were age 20 or when you were younger? Because I remember, I don't know how much of it's true, it's probably complete nonsense, but there was this weird conspiracy theory going around that was like an attempt by government somewhere or rogue states trying to improve their AI and face recognition software and be able to tell how people's faces age and all this kind of stuff. Wow. Probably complete nonsense.
No, I haven't. No, and I wouldn't have thought that would have been anything dodgy having thought, but now you've brought that up. That is quite scary that could happen. It could be a conspiracy theory.
I don't know if that's true. It's just a complete nonsense, but it just made me laugh. I think if I shared a picture of when I was 20, I don't think there are many that actually exist because it was pre-mobile phones and people didn't have cameras. But anyway.
Yours will basically be the same plus a beard, won't it?
It would be. I know I probably would have looked about 10, probably at a push 11. So I would have, I would have looked, I would have looked the same. You might have had hair, Andy. Did you have hair at age 20?
Yeah, thanks for that. Funny enough, I recently moved to a new house, so we've been unpacking some old boxes, and I have found some hideous photographs of me. And I even found an old work pass photo. You know, the old passes you used to get that used to clip to your top pocket before key fobs were a thing. I even found one of those. And it is hideous. I mean, I was about 5 stone heavier, which probably isn't a great thing.
Oh, that's the good thing. We can forget our worst moments, but obviously people put them on Facebook nowadays. They're there forever. Anyway, on to the Facebook Live piece. So forgive any sound interruptions or dropouts or anything like that. It was recorded live. So please do enjoy it, and we will see you on the other side. I would be interested in cash versus gold versus equity investments just now with market turbulence, and what split would you suggest? Now, I wouldn't suggest one because obviously I can't give people advice, but later on somebody also asked the question, they wanted to know the performance of gold versus equity markets versus cash during this period, and I've actually produced a chart that shows those performance numbers, and you'll see that, for example, the FTSE 100 year to date is down about 24%. If you look at the S&P 500, it's down in double digits. It's not down as much as the FTSE 100. I think it's about sort of 14, 15%. It depends which day you look at because we've had a very strong rally. The thing there is the global overseas holdings will have had a boost from fall in the value of the pound. So that's why some of the overseas markets have done better than the FTSE 100, but the FTSE 100 does also have quite a big exposure to oil companies as well, which obviously the price of oil has fallen 70% year to date. Now, cash has obviously performed well because if you've got your money in cash, it hasn't fallen, and therefore at this point in time, you're still winning. Bonds have also done well. If you look at gilt funds, you'd have probably been up about 10%, I think it is year to date, and gold, you'll be up even more. I think you're up about 14% year to date. So these are haven assets that have performed well when the market has tumbled. It doesn't mean they haven't fallen along the way. We've seen periods of forced liquidation by hedge funds around the world, which caused the price of gold and the price of bonds to fall. But what it does highlight is that even though there can be a bear market in equities, the investment world is made up of lots of assets. So there are bull markets in gold, and there are bull markets in US treasuries and certain parts of the bond market. So there are places where you can invest and be making money even through periods that we've had. Now, the question about how much gold you should have is an interesting one. About a year or two ago, I did a whole research piece on 80/20 Investor around the idea of gold, because you see a lot of stuff in the press that says buy gold, hold gold, it's a hedge against inflation. It seems the way they talk about it, it's a hedge against everything, and it's not. The problem with gold is, as Warren Buffett once said, it's basically if you buy it, it's normally bought in periods of fear by people, and you're hoping that somebody further down the line is going to be more fearful than you are at that point and pay you a higher price for it. Because gold in itself doesn't actually do a lot. It doesn't produce an income. As a metal, it's not used massively in production. It is to a point. I know there are some uses for it in gold, but when it comes to investing, a lot of the demand is driven by people who go into it as a haven asset. The problem is with gold is that if you look at the chart for gold and the gold price, so if you go on to Google, just Google the gold spot price, and you can find it on things like Bloomberg, you will see that the price of gold is incredibly volatile. It goes up and down almost like the stock market. And so as a hedge against volatility, it doesn't work in the way you might think, because the more gold you have in a portfolio, there comes a point as you keep adding gold that you actually start to increase the volatility of your portfolio. So it isn't a hedge against volatility at all. So yes, in periods that we've had now when there's mass fear, and it's a real extreme fear, gold does well, but it is volatile. Gold does, if you put it in a portfolio, help to reduce the size of your maximum losses to a point. But again, if you hold too much, then it starts to increase them. When you did the numbers, I crunched portfolio numbers and did it for different percentages of gold. And if you had 5%, 10%, all the way up to like 50, 60, see what would happen. And it worked out that if you hold more than 5 to 10% of your portfolio in gold, then you start to increase the frequency of your losses and also the frequency of your gains. But what it means is your volatility starts to go up. So it can start to be counterproductive, because we have seen some wild swings in the price of gold. So if people want to buy gold, then I think some of the conventional wisdoms out there of only holding 5, 10% have actually got a grain of truth in them. So I can't say whether you should, or that's down to you whether you buy gold, but just bear those things in mind. The next question is, what are your thoughts on and views on all-weather and golden butterfly asset allocation portfolios, which are meant to do well despite any stock market event? For those of you who don't know, there's portfolios that were constructed by Ray Dalio. They're based around holding a set asset allocation forever, and some people think they're almost like the holy grail. And really what happens if you look at them, they're based around holding some equity exposure. Most of it's in the US because it's a US concept, and quite a significant bond exposure with a little bit of gold in there that's thrown in for good measure. Now, I've not gone through and crunched the numbers on these portfolios, and the 80/20 investor research covers things like this. And about 5 years ago, I came up with a bit of research and I decided, is there a perfect portfolio out there? Ignoring anything else that had been done before, if I looked at the average return from any fund, so it had to be any fund at all, regardless of the sector, looked at how it performed since ISAs came into existence in the year April 2000, was there a combination of assets that meant that you made money in every tax year, a positive return in every tax year? That includes across the fallout from the dot-com bubble, the financial crisis, and even up to now. Obviously, I've updated it, but at that point, 5 years ago, it was obviously up to just after the financial crisis. And could it also have outperformed the FTSE 100 over the entire period? And the asset mix I came up with was quite simple. It was a combination, effectively, without giving it away, was of equities, but predominantly, again, in fixed income, particularly gilts, and a bit of cash. And this particular asset allocation it's been tested all the way through the last 5 years, and it's held up, even the tax year that's just passed. So do I think these perfect ideas do work? Yes, they do exist because I created one, but they won't be foolproof, and they have produced very good returns. The one thing obviously we'll say is that a lot of them are based around bonds doing particularly well and continue to be doing really well. And you could argue that we are in the midst of a bond bubble. So just like equity markets have been in a bit of a bubble. So yes, they work. If you want to look at the perfect ISA portfolio that we created, then you can go and take a free trial of 80/20 Investor. Somebody has asked, hello, I would love to hear more about income investing, e.g. options, how best to structure an income producing portfolio, what to pay attention to. Also, is it a good idea at all for someone with lots of time ahead and not huge amounts of money to chase income? Or is it better to invest for growth in this situation and forget about income until substantial amounts of money is accumulated? Now, I'm going to take that from the angle of how to produce an income portfolio, because there are things you should try and do. So if you're trying to produce an income from a portfolio, you can buy shares. And the big problem we've got at the moment, as I spoke about a couple of weeks ago, is that companies are cutting their dividends. So they're not either lowering guidance, saying they won't actually be paying out a dividend, or they've actually stopped doing it at all. So for people who buy shares in companies direct dividend and then to use that to live off, that's obviously going to be proving difficult. And of course, the value of those shares have fallen anyway. That's a secondary consideration if you're just living off the yield. So all you're worried about is the income. You're not buying and selling these shares. The thing is to buy funds, income producing funds. You can buy particularly equity income in the UK, global equity income funds. And what they will do is invest in lots of companies, 50 to 100 in each fund, and they will take the dividends that come in from the shares that they hold, and they will produce a payout to investors. So the payouts tend to be more stable and much more diversified. So even those funds will start to see their payouts drop. It's almost inconceivable that they wouldn't, because of the way particularly unit trusts I'm talking about here are structured and the way they are able to pay income out. When we produce research on 80/20 Investor, one of the things that I've done is produce an income heat map. So it's like a heat map with different colors for each year going back before the financial crisis. And it tells you who has grown their dividend year on year, who has cut it, who has kept it the same. So visually, you can quickly see funds that have grown their dividend year on year, because if you're investing for income and you want to live off that income, you want it to grow to beat inflation. Otherwise, what will happen is your income will lose value. It will actually, purchasing power will drop. So the thing you want to look at is, of course, you look at yield, because that's about the amount of money that you could potentially, or the percentage income you could get from the amount you spend to buy a fund or share. But of course, in this environment, that yield figure is going to be probably unreliable. And so you want to look at payouts, really, how consistent they've been in payouts, and particularly focus on the financial crisis, because if a fund had managed to keep its dividends and payouts going through that period, then it has a probably better chance of doing so now because it's done it through a previous bad period. Think globally when you're building portfolios. That's the other thing, because people always focus on the UK. To give you an example, over in Japan, a lot of companies in Japan are very cash heavy. They have been for a long time, had a lot of cash on their books. And while their dividends they were paying out were low by comparison to other companies around the world, it does mean their dividends now are going to be much more sustainable. Yeah, it may only be about 2%, but it may be more sustainable because they've actually got the money to pay out. So look globally, because you could benefit from diversifying your income stream. The other thing I would say is do look at investment trusts. Now, investment trusts work well because the way they're structured is they are able to hold back income and smooth out their income payments over time. And unlike unit trust, that means that they, even in years where they have a hit to their income that they receive, the dividends, they can increase their payouts to the investors who hold shares in their investment trust. Now, on the heat maps I did for the investment trust world, what you can see, there are investment trusts out there that have never cut their dividends. They've grown them year upon year upon year. So there are ways out there in which you can get investments funds that have shown a history of producing a reliable income. Doesn't mean they always will. The other thing to do is make sure, if you're looking at investment trusts, you can find on the Association of Investment Companies, the AIC, they have or they list all the investment trusts, and you can see something called the revenue reserve cover, and it tells you the amount of money they've got and how many years worth of dividend they could afford to cover from their existing cash. And it's normally stated in years, so 0.8 is about the average. So you can get insight into investment trusts, how likely they are to be able to cover future payouts. And the other thing I'd mention before I move on is if you're an income investor, if you're living off the income that's being produced by a portfolio, it makes sense to have a cash buffer. So you have 1 to 2 years worth of income in a cash buffer, which may be within your investment platform that you use, and the yield that is naturally produced by the investments drops into that cash buffer, but you actually draw your income from the cash part. So if you have a period like now where the income being produced by the investments actually falls, you can still draw from your cash reserve here, but you don't have to cash in your investments at a lower price. So if you're living off the income, you're not so bothered about the value of the shares themselves. You're more bothered about the ability for the investments to produce a reliable income. Hi, Damien. Do you agree with the old adage about asset allocation, 100 minus your age for equity exposure? If not, what would be your method of asset allocation? Now, to explain to people who don't know what this is, the theory, the sort of adage is that you take your age. So if you're 40, you minus that from the number 100, which would give you 60, and your equity exposure in your portfolio should be around 60%. It's not hard and fast rule. It's a bit of a finger in the air type of rule. The other 40% would be in lower risk assets. Now, it's a good starting point for somebody who would be a medium risk type of investor, because what this rule doesn't allow for is the individual risk levels, and it's not personalized for anybody. So you may have the example I gave, somebody who was 40, they may be really risk averse. Well, they won't want 60% equity exposure. They can have far less, or should have far less. So they would need to adjust it. Now, what do I think about the rule? I actually think, as a basis, I think it's a good starting point. Now, I remember when I used to work in the city, and we used to go and see some of the investment banks and look at what they were doing, and they were seeing the very rich clients that the company I worked for had. And these guys and ladies, there was lawyers, they were earning millions of pounds a year. And I'd never met people so rich. And when we went to them with the discretionary fund managers who had all their very clever ways of investing money, and they had a very clever and expensive investments, I did almost laugh inwardly when I was talking to one of them, one of the investment banks, and at their heart of what they did was this basic principle. Now, I'm not saying they all do this, but it is something that is used as a gauge by some of the investment banks out there as a basis of trying to get people to understand risk and how much they should take. So it's not something that is outlandish. to give you an example of how you might adjust this, if you go to Money to the Masses and you look for our investment calculator, I actually built a calculator based upon this principle that's based around this whole what age you are, and then allows you to move it up and down based on your risk tolerance to see how your asset allocation might vary. So it will show you the potential asset allocation in global equities, UK equities, and it's based upon some of the leading ETFs that are out there that have, say, 60, 80%, 100% equity exposure. And so that shows you, if you move up and down the levels, what a diversified portfolio could look like if you wanted 60% equity exposure. So it kind of takes this rule and takes it onto another level. So I think personally, it's a very good starting point. It's not a hard and fast rule. It's much more important that you pay attention to your own risk tolerance and your own personal circumstances when you build a portfolio. And there are a number of tools out there that help you do that to a much more accurate degree, a bit more Q&A and questionnaires that come up with a risk portfolio.
So there we are. That was a selection of our best questions on our recent Facebook Live. And Damien will be doing that again soon. If you want to get involved, join the group. It's facebook.com/groups/money to the masses. And you can get involved yourself and see Damien recording that live, and you can post questions to him as he's doing it live as well. If you want to get in touch with Damien in the meantime, it's Damien@moneytothemasses.com. Twitter, it's @moneytothemasses with the number 2. We're on Instagram and YouTube and everything else. Don't forget to review the podcast if you can. Pop online, give us 5 stars. When we're through all this, we may even be able to say that that is mug worthy and send you out one of our famous and coveted Money to the Masses mugs. Damien, I think that's it. We're pretty much done, aren't we?
I think we are indeed. Can I just say, I think that's the best you've ever done in terms of closing the podcast. You did that all in one take. It was just amazing. I was just sitting back admiring. But yeah, anyway, so that's it for this week.
Why do you bring that up? Because they don't know I don't do it first take every week. We're letting people in behind the curtain.
I don't do everything I do first take. That's why Facebook Live is so good, because it shows you everything. Anyway, until next week.
Until next time.